people would point to that as kind of the beginning of what has become known as the seed surge. And so the seed surge being, there was just so much money coming into that seed category, whether it was new fund formation or larger funds establishing their own seed programs. It became the place to be, and that hole that we started to see by 2015, 2016 was starting to not only close but also become stuffed full of options for entrepreneurs. So when we started Indie.vc, we started to see seed investing kind of taking the path that it was taking. There started to become other gaps that open up, and one of the gaps that we became pretty fascinated with was this notion of, there was this kind of binary framework for entrepreneurs to think about their business. They had to either bootstrap it and do it all on their own and self-fund it and take all of that risk on themselves, but they get the benefit of owning all of the upside, or go the VC route, which, by the time seed investing had become what it is now, it had really evolved into this kind of cadence of raising your seed round, then usually 12 to 18 months later, because that's how much money you were raising, you would be targeting your next fundable milestone. And it became this kind of treadmill of fundable milestone after fundable milestone. A lot of entrepreneurs, that didn't resonate with how they thought about building their businesses or how they wanted to limit their potential universe of outcomes. So that to us started to look like another one of those seed gaps. But then what we started to see over time, and what I think's become more apparent over the last 2 to 3 years, is that it wasn't just about bootstrappers and VCs. It was actually, there's something more meaningful going on. There became this duality of, like, you're either small ball and you're going for like a lifestyle business and you're always going to be small, or else you are really going to go for it. You're going to go big or you're going to go home, and you're going to really try to build not just someone who leads a category, but someone who dominates a category and leaves scorched earth behind it. And I think that's the model that we're kind of stuck in. And as a seed investor, what I was feeling back in 2014, 2015 was pre-product, pre-revenue, pre-anything. I was having to start making decisions around what to invest in that could become that kind of dominant. And when you start to do that, you start to look at less about how great the business can be. You start to look at more around how fundable that business can be down the road. And I think that, I think entrepreneurs and investors were starting to feel that pinch, and so, we wanted to do something about it. So my tongue-in-cheek quote is that, unicorns ate seed investing, and if you look at the crop of seed investors and the model that we're working towards, in many respects, that's the question that VCs used to have to ask themselves was whether something could be a billion-dollar business, and now everybody is asking themselves whether something can be a billion-dollar business a priori. I think what has been interesting to me across my venture career is that a lot of these billion-dollar businesses didn't look that way in their first 3 to 5 years. And yet we're trying to make a judgment call on those at the very earliest stages. And as a result, it's affecting how seed investors process deal flow. It's affecting how VCs process deal flow. And I think that is a totally justifiable path. I just don't know that it's the right one for everybody. What we're starting to see now in terms of that theme of unicorns eating seed investing, you'll see, in the far right column, 2018, you're seeing seed as a category. Even though 2018 was the most flush year of venture capital ever invested, most of those dollars are consolidating to the later stage and growth rounds. Actually, early stage investing over the last few years has been on a continuing trend down. I think in large part because people are less willing to take risk because there's so much funding risk in something that doesn't look obviously like a billion-dollar business. The other consolidation that I found troubling as well, and I think is getting its airplay now, is that when you're looking for a certain kind of business, it tends to consolidate around a certain profile of entrepreneur. And so if you look at the kinds of entrepreneurs that tend to attract funding, you're looking at, 98% of venture dollars still flow to men. You're looking at 80% of VC dollars go to effectively 3 states. 1% of those dollars flow to, less than 1% of those flow to different minority groups, and less than 6%, less than a single percent of businesses have access to any venture capital at all. And so as those kind of fundable profiles and archetypes calcify, what we're seeing is that those dollars available to entrepreneurs who look or want to work or act different are consolidating there as well. In response to the New York Times article this weekend, Bill Gurley, who's probably one of the most successful VCs of all time, said, 99%, 100% agree, vast majority of entrepreneurs should not take venture capital, And interestingly, if you play those numbers forward, even those that do take venture capital, when you think of venture as an asset class achieving what it's set out to achieve is those billion-dollar outcomes, then even that slight, that fraction of companies that Bill believes ought to take venture capital, less than 1% of those, 0.07% of those actually reach the billion-dollar valuation mark. And so, the funnel is just so narrow in terms of how the venture industry measures success. That's not a knock. It's just to say entrepreneurs deserve different paths, even if they want that same kind of outcome. And that's what we set out to do with Indie.vc. 4 years ago, we introduced the concept of Indie.vc, which at its very simplest was, we want to work with entrepreneurs to get them to profitability, not their next round of funding. That was our goal. We wanted to see if that would change, how that would change their business, what kind of position that would put them in as founders. And so here's what we've seen over time. The median amount of revenue that they had coming in to work with us was just around $250,000 in revenue by the time we started to work with them. That revenue increased about just over 100% in the first year that we worked with them. And over the 24 months, we were seeing an average increase of revenue around 300%. Our median investment in those companies was $250,000. Median equity option in those businesses was 9%. 8 of those 17 companies we've done so far are doing $1 million or more in revenue now. And 50% of the companies we've funded so far with this model have been led by female founders. 20% have been led by black female founders. Goals with V3, we've experimented with a lot of different structures to kind of marry the idea of equity upside, but also kind of an out in the event that an entrepreneur doesn't want to raise any more capital and wants to grow the business on cash flow, that we can have a lever that allows us to get a return out through some revenue sharing. And so, our goals with V3 is make it clear and a shorter term to get to our first repurchase is what we call them. Create a more tax-efficient distribution system than just paying us out in revenue. With each payment that people make, they are able to actually repurchase our ownership. And so we are able to treat that as long-term capital gains, and they're able to treat that, they're actually able to increase their ownership as they're succeeding, not continuing to decrease it. We want to have entrepreneurs be able to maintain equity and optionality, and then we also create a strong narrative around the Indie.vc gap and opportunity, that entrepreneurs see that there's other ways to build scalable, ambitious businesses than the one size they see fitting everybody else. V3, the idea here is we structure it effectively. I think we get cast as doing something super radical, that we're reinventing venture capital. The probably less glamorous way to frame us is that we basically have created a convertible note with a release valve in case you decide not to raise any more money or sell the business. There's a way for us to get our return out through a revenue share. That's really the only fundamental difference. What we wanted to do more than anything is to create a structure that allowed entrepreneurs to keep optionality on the table as long as possible. But we did want to put them in a position of profitability there where they didn't have to take any deal they didn't need to take. So we call it an equity repurchase versus revenue share. this is, it's just a structural difference. The primary thing being it's not a loan. You're actually repurchasing your equity, so that with each payment, your equity increases and ours goes down. And in our structure, you can repurchase up to 90% of your equity at once you've hit what we have set as a 3x cap on those distributions. After we've hit that 3x cap, you're off the hook in terms of cash distributions. Conversion trigger remains the same, acquisition or what we call a qualified financing at $5 million. And with V3, I think what we tried to show was just how material the impact of our terms are in contrast to a traditional venture route. So with this graph, it's harder to see on the presentation, but it's actually, we have a live interactive graph on our V3 launch. But the idea was to contrast if you did your seed, Series A and B, what your cap table would look like. As you can see, by the end of your Series B, VC, investors own the majority of the company. In the VC route or the Indie.vc route, you take your seed round with us, you fund your A through revenue, and if you choose to raise again, you can see the kind of material difference in the ownership. If you choose not to raise, your ownership's even better. So those were our goals. We hope it's pretty clear. What I wanted to do is invite a friend of ours who actually just moved to Austin, David Hauser, who was the founder of Grasshopper, a company that he bootstrapped and scaled to tens of millions in revenue and ended up selling within the last 3 years to Citrix. Thought it would be helpful to bring him up and do a quick Q&A so he can explain a little bit how the ideas that we're putting out there with Indie.vc and that focus of revenue instead of rounds affected how he thought about and scaled Grasshopper, but also how material that kind of acquisition can be if you are equity efficient in building your business. And so, David, if you wouldn't mind coming up. Go ahead. These slides are not on the Indie.vc website, but a lot of what we shared in there is in our V3 announcement post, which is just linked at the top of the site. You bet. And our documents are all on GitHub too. So we try to publish everything we're doing for people to steal. You good?
Good.
Okay. This will be, your third week in Austin?
Yep. Third and 3.5.
So maybe a little bit of background. Some of you might have heard of Grasshopper, some might have not have heard of Grasshopper, but maybe like a little context around the company, what you guys did, and how you bootstrapped it or why you bootstrapped it. Maybe that would be a good place to start.
Sure, yeah. Can you hear me without this? No. Okay, just checking. So Grasshopper, if you haven't heard of it, it's a virtual phone system for entrepreneurs. I started it with a business partner of mine now 15 or 16 years ago. Sold it a few years ago. Bootstrapped it 100%. So from 0 to 30 million in revenue. We had 42 employees when we sold it. So very efficient in what we were doing on a per person revenue basis. And we got really good at doing SMB marketing, right? That's all we did. We were not a technology company. Our technology was okay at best. And most of our team and most of our spend in the company was all in marketing. So we marketed to 1 to 10 employee companies, and we did it really well.
How did you end up, a lot of people think about bootstrapping. They'd like to bootstrap because of how much control they're able to keep and how much ownership they're able to maintain. How were you able to do it? A lot of people, can't kind of muster that first, few maybe months or years to get to the place where they can actually be paying themselves or paying other people to be working for them without outside funding.
Yeah, I mean, we didn't pay ourselves for a long time, but ultimately we got to a good position with that. I mean, I had previously raised capital, a traditional VC route in New York, so I'd seen how that went. We brought in a management team. I didn't like that process, and pretty early on decided that we wanted to do this ourselves, bootstrapped, whatever it was called. And we took all the money we had, about $100,000, and a bunch of credit cards, and begged and borrowed and stole and did everything we possibly could. I mean, literally, this was before Twilio and all the other stuff for telephony. So we had to like get a server and multiple servers and plug them into T1 lines in a data center and like the whole deal. So we had to go buy the servers, and like the first purchase for the servers and the telecom equipment was like $250,000, and we had $100,000. So we convinced the vendor, like in essence with our business plan, to give us some terms for no good reason because we were a brand new business. And we ended up paying him 90 days out instead of upfront for the original servers, right? So, and that continued from then on to when we hired our first employee.
How would you have handled that differently if you had been venture funded, do you think?
I mean, I know we would have done it totally differently because now I have capital and I've launched other things and we've done things very differently, and I think to our detriment. In Grasshopper, we had a labs function where we built other companies, one of them being Chargeify, probably one of the more successful ones that came out of Grasshopper. And I think because we had capital at the time, we did a lot of things wrong. I think the company would have been much more successful if we hadn't.
It's actually something we hear over and over again from folks who've bootstrapped or kind of funded their companies in different ways, and that is because they weren't swimming in capital. When that $250,000 OpEx bill comes in, if you have the funding, you're likely just going to pay it. Very few people would have gotten as creative in negotiating that and kicking the can down the road and trying to preserve that cash because they knew in 6 months or whatever it was, they just raise another round and replenish it, right?
Yeah, I mean, I think the biggest thing that I learned was that me and my business partner did every job ourselves before we hired someone. And if we had capital, and now when we've done things with capital, we didn't do that, and we make big mistakes. We make mistakes in who we hire. We make mistakes in what they're doing. We make all of those things compared to doing the job ourselves and then hiring the person, right? And we did that at Grasshopper 100% of the time. I wrote the original code. I'm not a programmer. I mean, I understand code. I can read it, but I'm not good at it, right? So like literally every single job we did ourselves.
That's awesome. And but it's also, the thing that we hear over and over from these companies is that it's that managing your operation so closely, being conservative on the hiring, really understanding the levers of the business that comes from having to be capital efficient, not because necessarily you want to be all the time, but it's that moment in time, it's those early years that create so much leverage in the business down the road because, like you said, you've learned each and every functional area, and you've either done it well or you've done it poorly, but you have at least done it. And that makes a huge difference from what we've learned over time.
Yeah, and I think one of the most interesting things through the acquisition that we learned was that the things we learned in years 1, 2, 3, 4, and 5, and so on, were very valuable to the acquirer, right? So our capital efficiency, our cash cycle, all the things that we had to do as a bootstrap business were very valuable to the acquirer because it made us a more attractive business, right? And not on purpose, just because we had to.
So you're saying they actually like buying accretive, cash flow, profitable businesses?
It's crazy, yeah. It's a bizarre concept, but yeah.
I mean, and I think, like we can laugh about it up here, but if you're reading the headlines, that's what you're hearing every day. They're like, that's a terrible position to be in. The last place you want to be is profitable because clearly you're not being aggressive enough, you're not spending fast enough, but it actually ends up being a real asset over time. Talk maybe a little bit about contrasting your experience bootstrapping and outcome with, say, some of your more heavily funded competitors.
Yeah, so it was a really crystallizing moment when we went back and looked at this, and we had a very heavily funded competitor, RingCentral, in our space. They ultimately had an IPO event. They were funded by Sequoia and a bunch of others through a number of rounds. And when you go back and look at the numbers, the founder in that company, although the IPO was bigger than our sale, made tremendously less of a return as a founder, right? And multiples less. So I think it was a difficult time when people kept saying, "Oh my God, they're gonna, kill you guys." Oh my God, they have so much money. None of that was true. Obviously, we did very well, but as a pure outcome to the founder, it was significantly different.
Yeah. How did you manage your psychology when you kept seeing Ring Central or another competitor raising from such powerhouses as Sequoia, having 10 times, 20 times, 50 times more resources than you did? How did you manage your psychology in that? Because most entrepreneurs see that and they say, okay, it's an arms race, it's on. I'm going to go, try to compete on that front as well.
Yeah, I think what it taught us was we just ignored all competitors, right? So the experienced people we brought into the business were like, the people answering the phone should have a sheet that can compare competitors. And we're like, screw that. Forget it. Like, if you want to go to a competitor, just go to them, see you later. It's no problem. But we don't compare competitors. We don't look at their pricing. We don't care what they're doing. We added text messaging 5 years after our competitors, right? Because our customers weren't asking for it. So it really didn't matter. I think the biggest frustration on the team was probably our lack of TechCrunch coverage, because we had a full-time PR person and not typical PR, sales-based PR, so totally different. But he was gold on these things, and he just got so frustrated continuously because Ring Central was doing voice over IP and raising money and doing all this stuff, so they got that coverage. Right.
So how did you end up did you ever crack the code on how to get coverage? Because this is actually something we hear over and over from founders, which is they may or may not want or need to raise money, but they know that they can get press if they're raising money, especially from the right people. So how did you ever figure that out, or you did? Okay.
Yeah, so
what sold?
We created a process for this. We had some of the fanciest PR firms in New York and LA, and we fired them all. They're all garbage. And we, in essence, hired a really junior salesperson, and I've trained now 5 people in this process, put them out there to go and sell to editors, right? Go pitch stories, and not really editors as much as writers and people taking pictures and videos and whatever else. And we've gotten hundreds of pieces covered in this process. And they were paid as a salesperson, so very low base, $30,000 to $40,000 a year, highly commissioned, so all-in salary probably in the $75,000 to $80,000 range. And the pitch angles were never about funding, obviously, and we just came up with everything you could imagine, right? 2 crazy young founders from Babson College, 2 guys doing this, lost $1 million doing X, whatever we could come up with from an angle, and there's tons of them in every business.
Interesting. Anybody else have questions for David, as long as we've got him up here?
With regards to that last, let's say, set of activities that you just described, how much of that PR ended up providing, revenue generation?
That's an interesting question. So the question is, how much of that energy that they put into press and all the coverage they were able to generate, how much of that actually drove revenue?
Yeah, so we were highly concentrate on metrics in terms of CPA and conversion and retention and all of those things. So we drove the business that way. This was a difficult area where it was hard to attribute direct sales to a channel like that. But we knew when we were not doing these activities that total sales went down, right? Much like a lot of other channels like radio or television, where you can't attribute it, but you can see a total uplift, right? The same being true when we saw like an uplift in AdWords, right? That a lot of times coincided with coverage. So the way that we measured coverage was just by number of mentions. I didn't care about, was it New York Times or was it this? There was some change in there a little bit, but I didn't care about number of readers, any of that stuff that typical PR firms look at. I just looked at a number of mentions per quarter. And the goal was between 20 and 30 mentions per quarter for this person. And then between 1 and 5 wow mentions, meaning like Oprah, right? Like something that would change the business significantly or have a major impact, being able to put it on the press page or something like that. That's how we measured it. So I couldn't attribute a CPA, but when we loaded it all into marketing spend, we knew what our total CPA was, and we used about 15% of total marketing spend for branding and PR as a whole.
How much did you commission? You said they had a base of like 45 or something.
Uh-huh.
What did you commission them on?
Number of mentions.
Number of mentions.
Yeah, so there was a minimum number of mentions to hit the base salary, and then up from there, they could make an unlimited amount, in essence, based on number of mentions. And then the WOW list as well was a pure cash price, meaning every one of those you land, it was $2,500 paid cash. So what did the team look like?
Yeah.
Yeah. So the team was a small engineering team, probably about 10 people, maybe a little less. Operations team, which is a little bit heavier because we were running 24/7 real operations, so we handled that internally. Then the rest was marketing and no salespeople except for the PR person. So the marketing team was quite large. And that you could look at spend as well, right? So we were spending about $2 million on marketing a year, roughly, before the sale. The year of the sale, we spent $14 million of marketing before the sale because we ramped up radio advertising. So to manage that type of spend was a reasonable team.
And then, to be clear, you weren't funding that all out of cash flow. You'd open up a line at that point.
Yeah, at that point, we opened up a line. And important from a founder perspective, no personal guarantees, no options or warrants, and an interest rate under 6% is what we were paying. And it was a large line, over $6 million.
Yes.
And then
I've never been involved with a venture funding company that didn't just give up warrants. So this is I love hearing that that's something you negotiated out.
Yeah, we were pretty aggressive on that. And then we also had a call center in Florida that handled, because we were 24/7, handled some of our off hours and things like that, because we always pick up the phone, period.
So
42 when we sold.
I don't imagine
The team
Ring
is
Central
larger
was
now.
roughly the same, 42 people when they went public too.
I think they had 42 salespeople. little bit different.
A little bit different.
And I think to that question, after the sale, they've changed that dynamic of the team pretty significantly. There's much more engineering. There's those type of things. I don't think they're putting out a better product. There's more spend in those areas. We were very efficient, and they've cut back on marketing a lot. And magically, it's changed growth.
Interesting. Oh, that's
Thank you.
awesome.
Awesome.
There's a question over here. Do you hear the question?
Yeah. So the question is like, how do we look at months of runway before hiring someone, or how did that dynamic play? So first of all, when we first were hiring people, I had no concept of runway. I mean, just zero, right? It just wasn't something in my mind.
You just need to sell more. Was that it?
Yeah, I mean, it was very simple. I could not answer the phone as much as it was ringing, so we had to hire someone to do it. But I mean, we were very focused on what we were doing, which was selling. So like, we had no back-end CRM. Like I was answering the phone and typing in SQL statements to find the customer and the customer. Like, I mean, like that's where we were at. And we just continued on that path. So we never looked at runway ever, even in the later stages. And at that point, we were then profitable, so it was probably less of a question. So I not very helpful answer, but yeah.
Question back there.
Sure. I mean, this is a topic I can talk about for hours. So we started with XM Sirius as our first radio channel very early on. We were one of the first Howard Stern advertisers. Great channel for us. Now there's a lot of people that advertise there that are in the SMB space, It is no longer as a great channel, but it is still one that I would pursue if I was running Grasshopper. We did a lot of podcast stuff at different times with varying results. It was not the greatest channel for us. There were a few select ones that made a difference, Andrew Warner being one of them. That had a direct impact on sales. But look, I mean, the scale is just nowhere the same. Our minimum spend for radio, for terrestrial radio, non-satellite radio, was $12 million a year. Minimum, right? You could spend that in a week. So in terms of a scalable channel, at our stage, podcasts were no longer as an interesting channel. It was one that we maintained from a branding perspective, though. Again, 15% of total spend towards branding. I didn't care what the team spent it on. If they thought it was useful, that was fine. I probably pushed back a little bit on conferences because I don't think they're all that useful, but that's what they really choose, and that's what they choose.
I have a question for you. So, is this still on? Yeah. You were one of the first people to reach out after the V1 announcement of Indie.vc. What was it about what we were doing that spoke to you, or what was it about what we were doing that you got you interested or excited? You know, full disclosure, David's also an LP in the fund. He was helpful in getting it up and off the ground. But curious, what was it you connected to right out of the gate in terms of how we were talking about startups?
Yeah, so I had done a ton of angel investments. So at that time, probably about 50 or 60 investments, maybe a little bit more. And as an investor, I was never thrilled with how the terms presented, right? Like I was an entrepreneur saying, I bootstrapped, I think you should do similar things, but the terms were not set up right. So I think that was the first thing that drew me to what you guys were doing, which was trying to make an attempt at terms that said like there are other ways, right? Like not that any way is better than another, but there is a different way. I think that was the first thing. The second thing to me was finding, as an investor, a structure that aligned me better with the founder compared to a typical structure, right? And I think a typical convertible note that is purely based on this kind of fundraising wheel is not well aligned for me or the entrepreneur.
Mm-hmm. Well, I agree, and we're continuing to try to iterate it. I would love you to go just because we're not saying one path is better than the other, and I hope no one's taking that away from this. What we're trying to say is entrepreneurs deserve more paths, not just that we think we've cracked the code on anything. Because I want you to restate what you said about your outcome versus the Ring Central founder's outcome, because I think this gets lost in the narrative so many times. Even though they had they did exactly what they were supposed to do. They had the IPO, they had the best investors, but there was a fundamental disconnect in terms of the outcome to you and the outcome to those founders.
Yeah, I mean, so what I always understood was me running my own company. I never had a portfolio approach, right? So unlike a typical VC that can push me to go to zero, right? Either all the way or zero. That's my single option, right? In a portfolio approach, they have lots of those, right? Which is why it works for them. So I understood that inherently. And I talk to founders about this all the time, right? Like, I have only one game I'm playing, and I have to win that game, unlike my investor at that point. And then in terms of outcomes, yeah, I mean, the difference is quite large, where their outcome as a total absolute dollar figure was way larger than ours. The money returned to the founders was way larger to us. Significantly. I don't know the exact numbers.
Even though their top line, whatever their publicly traded price was so much more than yours, the actual outcome to
the founders
and
less.
Investors,
I mean, we had,
or founders and employees.
We had 2 people on our cap table.
Yeah.
Right? Me and my business partner.
Mm-hmm.
So we also had a lot more control. But yeah, I mean, the outcome to us was far different, right? So we didn't have to get to $1 billion event to have an outcome that would be life-changing.
Yep.
right? We sold for, call it around $200 million. It is not a small number, but in a typical VC return, that is not a great return,
No.
right?
Not after 2 or 3 rounds. I mean, someone who's at $30-ish million in funding is likely taken 3 to 4 rounds of funding at that point.
Right, and that's not a great return. So no one would be very happy, and we wouldn't have made very much return for us either.
Yeah, that's great. Well, I appreciate David sharing his story. We've got time to hit Q&A on Indie.vc specific. V3, I would love to get into any questions you guys might have about that. There's a hand right there. Maybe reframe that a different way. I'm not sure I'm understanding what you're asking.
So a lot of employees have expectations about I should get equity because I'm employee X. Sure. If you're bootstrapping, not planning to sell, just take cash distributions, what standards do you recommend?
Sure. Yeah, I can talk to this very specifically. So at Grasshopper, our company was based in Massachusetts and Boston. Highly competitive market for all talent, not just tech talent, but kind of across the board. So we got asked this question all the time. Equity, signing this, whatever. My answer is very simple. We give equity to no one. We don't expect to ever sell this business. So if I gave you equity, I'd be lying to you because it's worth 0, right? We pay above average salary, pretty significantly above average. And then we created not a profit sharing, but like an option pool of profit sharing in essence. So at the management discretion, we would fund that pool at the end of the year, and you would get a direct bonus based on that. So that was kind of the ownership feeling without having anyone on the cap table. That differed a little bit in our management team. So the kind of the 4 to 5 people on the management team, they were running the business. At the sale, we carved out directly to them amounts of money because we had promised that to them. Like, if we ever sold, we'll take care of you guys. But that was not on paper. We didn't have to do any of it. And that was the easiest answer, right? And anyone who said, I'm not working here because I'm not getting options or equity, I said, see you later, bye, thanks.
And I think that's something we see over and over is that, oftentimes these bootstrap companies will pay above market. But because there isn't an eye immediately on an outcome or an exit, they'll come up with some kind of profit sharing mechanism, whether it's the kind of phantom pool you're talking about. We're just passing through the end of the year, so you probably saw some of the posts from like Buffer and Wistia and ConvertKit and MailChimp that have these kind of active profit sharing pools for their employees versus a standard stock option plan.
And for us, I mean, I love the phantom pool because it allowed us to make decisions as a company and all participate, right? So at the end of one year, we said, look, as a team, guys, we can fund $750,000 into this pool, or we can attribute that to growth next year, right? And as a team, we can make that decision. And now we all own in that decision because everyone got a lower bonus. It wasn't just the owners, it wasn't just the founders, it was everyone participating in both the upside and the decision to grow, right? And the decision to grow, now everyone's bought into that, right? Like, my job is now dependent on, I gave up part of my bonus last year because I believe in this growth.
Go ahead. That's
kind of terms you have, success. So for the entrepreneur, it's a huge success. Is that enough success for them as investors and you guys?
That's a great question. So the question is, how do our LPs think about a return? How do they measure it? And I would say, we're still trying to find better ways to report the progress that we're seeing in the portfolio because their standard unit of measurement is an IRR. And so when you look at the behavior that you see in the venture business, so much of that is driven by the IRR. And IRR is a function of valuation, but also the time between rounds. And so, if you can get your companies to raise at a higher valuation in a shorter period of time, your IRR looks much, much better. And so within our Fund 1, our V1 companies, we have one company this year that's on track to do 20 million in revenue. They'll do multiple millions in profit. That's better than most of our companies across all of our portfolios. But they've never had a markup. And so I think that's the language we're trying to translate to investors. And, frankly, I probably didn't anticipate just how much rewiring it was going to take. But, we've got a company in that V1 as well who, they'll throw off, they came to us doing 10K a month in revenue, and this last year they threw off just over 2 million in profit. How do you report that to an LP where, that entrepreneur has turned down 3 term sheets last year at the same time, right? In a normal model, we would have been encouraging them to take the term sheet and get the up round. But we know that their focus on revenue over the longer period of time is going to end up netting us a better return, because with each round they take, not only do they take dilution and we take dilution, but we also take options off the table in terms of what a successful ultimate outcome looks like, not just what those kind of incremental steps up in the IRR look like. So I would say we're trying to figure out better ways to tell the story around how quickly our companies are growing, what their profitability looks like. You can map that against certain multiples in public markets. So it's not a one-to-one in terms of IRR, but it's something that thankfully we have a group of LPs who've been with us now over 4 funds. And when we went to go raise our 4th fund, which was primarily focused on Indie.vc, we said, look, we were right about seed. We think we're right about this. Are you along for the ride? We're going to be figuring a lot of stuff out as we go, and I think we have a healthy enough dialogue with all of them that's the case. I think talking to new investors is a little bit more challenging because they just haven't been coached up the way our current ones have been. Go ahead.
How do your LPs think about it from a portfolio perspective? It's sort of, they see it as like another VC thing, it has almost like private equity.
I mean, we frame it as VC. I mean, we think we're going to have competitive returns to any of our prior portfolios, maybe even better. I mean, when you have a company who you own a meaningful chunk of that's never raised outside capital, you've never had to take dilution, they've done it all on less than $1 million in funding. Even a pretty standard market multiple on that's going to return multiples of what we've invested, across all of our Indie.vc companies. And so, I think that people get hung up on our 3x and thinking that we're capping our returns at 3x, but again, it's just a convertible note. And so if an entrepreneur decides to raise a round or sell before we're completely paid out our 3x, we just convert into whatever's remaining on that, and we get the equity upside piece of that. Does that make sense? So I think we're very much still in the way I talk about it to our LPs is, across 17 investments we've made so far, 16 of those are still in business. All of the 8 original Indie.vc investments are still in business. So there may be a story here that says what would have historically been a 0 in a traditional venture fund is now a 1, 2, or a 3, and the home runs are still the home runs, if that makes sense. But we're providing entrepreneurs a different path and a different set of incentives to get to that same destination.
Is it possible for a business that started off on the VC track to pivot onto this track at some point? When is it too late?
I mean, I think there's, there were 2 notable stories this last year of folks who'd done that. We've actually seen it quite a bit, but the 2 big ones in kind of the traditional startup world were Wistia out of Boston and Buffer out of, which is a pretty distributed team. But, each of those had raised, less than 5 million. I think Buffer had raised close to 5, and Wistia had raised like 3. What they did is they bought out their equity shareholders out of their cash flow, and then they kind of reset. I think what we've found is that we've been able to work with companies who've raised like from angels or with seed funds, once you've gone past a certain threshold, I think you're then getting into like the full like recap buyout situation. But when you've raised usually probably less than $1 million or $2, I don't think it's too late. But I do think it's a hard conversation to have with your investors around recalibrating. And from our perspective, if we are going to go into a situation like that as a new investor, then we're likely going to ask all the previous investors to get on our terms, because our incentives are wildly diverging, and so we want to make sure that if we're going to get into a business like that, that we're all aligned and moving in the same direction. Does that make sense?
Do you allow your capital to go towards buying out? Only want to go to operations?
We'd prefer it going to operations. We haven't had anyone use it to buy out their existing investors at this point.
If someone has a term sheet for a venture debt from like a lighter capital,
Yeah.
where there truly is no covenants, no warrants, no personal guarantees, and they also have an offer from you, how would you compare? How would you advise it on or compare the two?
I don't see any reason why they couldn't do both. I mean, we usually have, lighter is pretty classic debt. They're going to be taking their cut of revenue the month after you close with them. Because we're a convertible note, we can give entrepreneurs anywhere between 18 months to 3 years before they even have to consider a repurchase plan, like something that's formal. And so I don't know that we would see them as an either or. I think there's an option oftentimes to leverage both. That's fine, yeah. I mean, oh, your point is saying like it's cheaper money?
Not necessarily.
Yeah, no, I mean,
I'm saying it's just like
it's,
David's point about having a cap table with 2 people on it, right? You would be a third on the cap table.
that's right.
A venture debt from like I'm talking lighter, not from the bigger.
Sure, yeah, yeah.
But they wouldn't be on the cap table. So I'm just.
That's right.
How would you normalize the cost of revenue-based financing, right, at 4, 5, 6, 7% relative to kind of what you offer, and maybe it's not a direct comparison.
Well, I mean, I think your last point is the right point, which is we have no cost of capital because we're a captured fund. We are a fund. We don't borrow. Lighter uses other people's money to kind of arbitrage a rate. We don't have that, so we fundamentally see them as debt, and we see ourselves as a hybrid that works well together, and that I think if a founder is debating one of the two. And they don't mind, starting to pay down right away as trading off against equity, or they're hypersensitive to giving up any equity, then Lighter might end up being a better partner for them than us. Up front.
You talked a little bit about the metrics in your existing portfolio, kind of looking forward for Q3. What industries or types of companies do you target? Do you have a preference in geography, or are you geography agnostic?
We're pretty geographically agnostic. I'd say we haven't done any international investing, and so we're probably tepid about rolling into that, just given how active we are with our companies. From a what we're looking for, it's hard to say. I mean, we're looking for more of a chip on your shoulder than we are an industry, right? We're looking for people who want to, who kind of share our DNA more than anything else. And then we're looking for markets where it makes sense, right? Like there were probably competitors you had who did like tons of R&D and reinvented the wheel and built a ton of new technology. If that's a company where there's a long lag between technology development and commercialization, it's probably not a fit for us, right? If it's kind of a winner take all, I saw limes and birds all over the sidewalks here in Austin. There are kind of land grab types of opportunities where a weaponized balance sheet actually makes a ton of sense and could be a competitive advantage. I don't think those are the types we play well in. I think the other one that's probably more subtle, but it's something that hopefully you all picked up on with David is, like, we need people who aren't afraid to sell. We don't want anybody who's going to call themselves business development. Like, we want people who are like they have to be open to developing a real sales culture, because that gets you as close to your customer and as close to ground truth on your business as anything else. And we found that the people who've struggled working with us are the ones who kind of look for any other thing to do, maybe work on HR, or maybe go pay some bills, but they aren't getting on the phone, to talk to customers. So that's more the profile. right up front.
Carry off on that question. You talked about wanting to avoid companies that have sort of a long technical lag to the product. But what about those that have a long lag in terms of the sales cycle, right? I'm in education, K-12. There's a long cycle there.
Yeah.
And so how's the fit in your mind there?
I mean, the question is, there are some companies that take a long time to come to market with technologies, and there are some markets that just have a long sales cycle in them. We have one company that sells into government, and I think the trick is not believing that you are going to be able to sell faster and scale up faster than you realistically will. And I think when you look at the venture-funded ed tech companies that get in trouble, it's that they think they've somehow cracked the code on shrinking that. I think for us, we would at least want to be able to understand the sales cadence and motion enough to know, like, is the risk in those slow sales, like when they hit, are they worth the risk? Or is it like, an incremental increase in revenue, and you can't get the kind of growth rate that we'd need to see to be interested in as an investor. Not bad. No, not bad. There were a couple other hands. Yeah, go ahead. Yeah, that's a great question. So, part of it is like the terms and the structure and the investment, but the other piece that I feel like has really become our secret weapon over the last few years is that David's a unique individual. He is definitely a snowflake, but there are a lot of Davids out there, and they actually don't get a lot of opportunities to talk to and share their story about how they built their businesses. I think one of the big mistakes we made early on with Indie.vc is we would bring in people who had scaled up companies but had done it with a lot of funding. And so it became pretty clear after the first quarterly retreat that we had a salesperson come in, like an amazing, really well-regarded salesperson at one of the top companies. He came insanely highly recommended. And after his talk, it was like, literally none of that advice applies to any of you. Right, like if you run this playbook, you will go out of business in 6 months because the whole pitch was like raise $10 million, go spend $5 million on a new CRM, go hire 40 new sales. Like it was like ridiculous. And so what I think one of the benefits that we try to create is we're trying to create an alternative universe of founders who think and want to build along these lines. And you can hear it when you hear somebody like David talk about, they just fundamentally talk about their business differently than someone who's sitting up here talking about how they raised or closed their Series B or their Series C. It's just a very different way to think about building a business. And so I think one of the primary things we try to bring as investors is exposure to and support around building your business along those lines versus what you're going to get from most other investors. I think other things we do is we have these quarterly retreats where we one of our founders calls it just enough VCBS, right? Like there's just enough accountability. There's just enough. I mean, you didn't have a board when you were building your company, right? So like no one's calling him every month and asking him how his number's doing. He's not reporting to anybody but himself or his partner. What we try to do is be that phone call is coming every month and is going to ask how it went. Did you hit your numbers? Did you miss your numbers? Why? We're going to surround you with other entrepreneurs who are roughly at your same stage, going through some of the similar things. We're going to expose you to entrepreneurs who are 2 or 3 steps ahead of where you want to be. And we think that's created this really interesting dynamic where entrepreneurs are learning more quickly. They're able to scale more quickly, but they're also able to do it in a way that maps to their values and what it is they wanted to build. That help? Okay. One over here. Yeah. Yeah. if they can't, so the question is, when do those kick in? That's negotiated anywhere, but for us, it's been anywhere between 18 months to 3 years. What happens in the event that they can't make those payments? Is that we have the right to have them either we can force a repayment. So they would effectively have to get a lender to help buy us out if that's the case. I mean, you were talking like legally and structurally. That's the thing we have in place to be able to do that. There is a scenario where they forego a series of monthly payments, and then regardless of how much they've paid back, we can stall those payments, but then we maintain our full initial equity option in the business. I think what we're trying to do throughout all of this is to not be a lender. We're trying to be a partner, and so we're trying to, we obviously are a legal entity. We have obligations to ourselves, to the companies, and to our LPs. But we also want to be able to have a conversation around this stuff. No one is interested in taking over anybody's business or shutting it down. We don't have any levers to be able to do that. We haven't had anybody hit that scenario yet, but that's certainly an option that is anticipated in the term sheet, but it's one we hopefully are able to have a series of conversations around before we have to decide which one of those 3 paths we're going to take. Let's go hand in the back. Sure. That's a great question. So to our LPs, how many of them were like pounding the table? Yes, we have to do this. How many of them were no, or more cautious about it? To give you a sense, we lost 80% of our LPs between Fund 3 and Fund 4 when we pitched them on this idea. It was not very well received. For those who did do it, they did it because they trusted us and they thought we've been right before and we might be right again, and they didn't want to miss out if we were right again. So that was, no, so we did V1 out of our 3rd fund. With Fund 4, we've been going, that's a dedicated fund for this. Yeah.
So I invested, doesn't work. I invested as an LP just to give back to bootstrapping. So my assumption was the fund would fail, not because of the terms or because of price, but because it was new. I had no idea, right? So as an LP, there are multiple motivations for investing, and it wasn't a huge investment, but and I do believe that Bryce and the fund will make a return, and my hope is a very good return, but that was not the primary factor for me to invest.
Yeah.
Sir?
We're just putting the fund to work. I think we're about 20 to 25% deployed, so we still have a ways to go before we're in market again with a new fund. Go ahead. This one's a $25 million fund. Yeah. I thought I saw a hand back here, but there's one here.
This isn't working, but on our balance sheet, we held a percentage of profit. We never shared that with employees outside of the management team. So we held that on a monthly basis, so we had a line item for it. At the end of the year, we made a decision about what we did. Sometimes we did more, sometimes we did less, based on decisions moving forward. So we tried to, have a practice of sticking to that, so we didn't overspend and had an idea, or make a decision we knew. The percentage, I honestly, I don't remember exactly what was held.
Okay, there's one tepid question. Go ahead.
Super quick, as a follow-on to what you just said, if you're creating a monthly accrual and it's a steady amount, did that create an expectation that it almost became like a supplemental bonus program or supplemental to income?
Yeah,
Was there still a
Yeah, so it was never shared with employees except at the end of the year. So only the management team saw that high-level report that included that. Anyone who had P&L responsibility would never have seen that line item unless the management team. But to answer the broader question, we played with all sorts of schemes from a bonusing perspective. We did quarterly, we did core values based, we did all sorts of crazy shit. We were one of the early customers with success factors, and they had a whole bonusing scheme and all this stuff. None of it worked, as well as just a yearly bonus that was based on management discretion and the success of the company without a direct link, and one that was not tied to individual performance on a daily or weekly basis. That might work in a widget factory, but not for the type of work that we do.
Thanks for the clarification.
Go ahead.
Who else is doing what Indie.vc?
I think there's different flavors of it. I mean, I think when we started, there weren't a whole lot that kind of looked like.
There was no one else.
Yeah. I think now, you're starting to see, like there's Tiny Seed, which, is kind of, I think they call themselves Y Combinator for bootstrappers. There's Earnest Capital, which is kind of, it's looking, kind of, it looks like it's taking pieces of our model, but maybe adapting it. I don't know. I think they're working on potentially like an equity piece, but I think they're set up to do, and Tiny Seed and Earnest are kind of set up to do kind of pre-revenue types of companies. But I haven't seen a whole lot of other models. I mean, I think we get lumped into the same camp as the lighter capitals, the SaaS capitals, the clear banks, I think as a category, there's probably a story to be built around what we are calling equity efficient businesses, right? Like, equity is the right tool for some things, and right now it's kind of the hammer in the toolbox that everybody's using. And so, can we create, more tools that entrepreneurs can leverage to build their businesses? And I would put each of those in kind of a bucket that would be similar to ours, but each of them is pretty unique right now. I mean, what we look for is, we look for at least 35% or greater gross margin. But, and I think most of our businesses have that or better. But I don't know that there's any other metrics that we necessarily tie to it. I mean, I think that, the conclusion that I'm coming to over and over again over the last 4 years is that this is a better model for most companies. That, no one is going out of business because they focused on profitability and customers and revenue too soon. And if we can encourage that structurally, or if we can encourage that through the narrative, if we can encourage that through our community, I fundamentally believe we're going to see more, not that we're going to see a bunch of middling companies. I think that if we can support companies along this path, I think we're going to see more grasshoppers. I mean, you all saw the Qualtrics outcome this last year, $8 billion for a business that effectively raised 2 rounds of funding, and it was all secondary. I think last year you saw GitHub, get bought by, Microsoft. That was a company who had bootstrapped and raised 2 rounds of funding, but only at $1 billion plus types of valuations. I think we lose the plot on those companies way too easily, that there's magic that happens on focusing on customers' revenue and profitability early that we want to discount because it doesn't fit the narrative. And what we're trying to do is tear down some of those walls to be able to show entrepreneurs that there's another way to think about building their company. There's other entrepreneurs who are doing it and doing it successfully. And that if we can support them, if that path speaks to them right now, there's no way to pursue that other than to forego funding altogether. And what we're trying to do is we're trying to give them just enough of it to be able to allow them to continue down that path without having to swallow, whole cloth, everything else that comes along with the traditional model. I think, let's go right here.
So have you played, you
No, we try not to be helpful to our companies. Yeah. Yeah. I mean, look, we're as involved as anybody wants us to be. I mean, structurally, we're set up to do quarterly retreats as a group. You know, so once a quarter we meet. You know, we did one here in Austin last year, and had people like Ronnie from Indeed, who, again, that's another great story, right? Indeed raises one round of funding, $5 million, sells for over $1 billion. Like, you don't hear that story very often, but these are out there if you're looking for them. So the quarterly retreats is one. We do monthly check-in calls. So, you know, we schedule a half hour. They usually go for an hour of just, what do you need? You know, how did you do? Those kinds of things where we check in. And then, you know, some companies want more of that. So there are some companies I do calls with every week. We have an internal Slack group where, you know, there are founders who I message all day, every day, because they've got questions or want intros or they're at a different inflection point. So we try to be available as possible. We try to bring in, you know, people like David and others like him into our network so that if there's something they can be doing to be helpful to our entrepreneurs, that they have immediate access to them. But we've also been doing this for 20 plus years. So we have, you know, I have a venture network that we can start applying to these kinds of companies that we think is pretty valuable. Yeah, we have them up on the website. In our FAQ, you can see some of those companies that we work with. You know, like most bootstrap companies who aren't raising a lot of funding, they don't get a lot of press. But, you know, one that people tend to know publicly is a company called The Shade Room, which is a, you know, very popular media company. You know, she came to us doing 10K a month in revenue. She'll do, you know, multiple millions in revenue and multiple millions in profit this year, you know, after 3 years of working with us. So, you know, it's stories like that that kind of are encouraging us to keep pushing on this. Minimum investment as a percentage and as an amount. So, you know, dollar amount, the minimum investment we've made so far is $100,000. And the minimum ownership, I want to say, is probably 5% of an option. In each of those scenarios, people still have the ability to buy down our options. So in that case, if they hit our full 3X, then we'd actually only have 0.5% of an equity option in that business. At 3X, though. Yeah. If they convert, then we convert in whatever's remaining. Or, you know, I mean, I think the Easter egg in our terms that fewer people have picked up on is that you can actually buy us out at 3X anytime. Yeah, you can pay it in one lump sum if you want. If you know you're going to get bought and you want to buy us out and get your ownership back right before that, like, you can go take out a bank loan and buy us out. There's no recourse. That's my question. Why aren't more people doing this? Sure. Very sexy. Look at this guy. Come on. Don't say that. Philanthropic?
I'm the odd LP.
With debt, whether it's from Lighter or whether it's from SVB or if it's from anybody like that, all you're getting is money. So if that's all you need, and all you're concerned about is cost of capital, you should definitely take that. If you want a partner, if you want someone actively involved in helping you scale the company, if you want likely more capital up front, if you want looser terms around repayment, if you want to be part of a bigger community, if you want to have the same kinds of results in your business of growth that we're seeing across the board with ours, then you should consider Indie. It's a fundamentally different product. I mean, people are literally. I mean, people in this building are giving up 3% of their company for a desk. You know, we're saying, if you give us 3%, you actually have an option to.
I'm going like the David route, which is these are people that want to bootstrap with
Yeah.
no equity, not even an employee.
Totally. Well, and what we're trying to find, what we also realize is that person may not be our customer, right? That person, if they're that hypersensitive to their ownership and equity, then they just might not be our customer, and that's okay. Like, we're fine with that. What we're trying to do is, what we would want is that founder to at least, if they're successful going that route, we want them to come back and talk to our founders about how they did it. Because I think the more stories like that that we can uncover for founders to hear, the more spectrum they're able to see in the path of entrepreneurship, I think the better everybody is. And I think that's what we're trying to do in telling the stories of our founders. That's what we're doing in trying to elevate the story of people like David and folks like him. And so, you know, they're tough cookies, man. But I mean, I do think, you know, I think
there's two different groups, right? There's one set of bootstrappers who are running more of a lifestyle business and are not looking towards growth at all. And then there's another group that is looking towards growth, and they're probably a little more flexible on equity, on terms, on whatever. And look, like I took venture debt in a form from SVB, right? I would have loved to have this model available only for just the connections and the weekly quarterly retreats, because I had to build that network myself in Massachusetts, right? Like, there was no one else I knew, so I had to go find those people. Just that would have been valuable to me without any of the other stuff.
Would you give up equity though right before sale? I mean, you did it very strategically to pump up the company right before sale. It was very smart raise at a smart time.
Yeah, would I have given up equity? Yeah, I would have in that case. But the struggle I have is from the LP side is if someone can buy out that option right before a sale, I don't think it's a great option. Right? That's a.
Has anyone done it yet?
no one has. Almost everyone has asked us if we, once they build a relationship with us, they like the idea of having us as shareholders. And so, even if it gets way more expensive. I mean, I think that's, you know, I mean, I think that there's a softer side to all of this that I think gets lost in the spreadsheets, and that is when you have a relationship with someone, when they've invested not only capital and time, like the entrepreneurs we work with really enjoy working with us, and they want this model to be proven out as much as we do. Each of them ties their own success to ours, right? Like, we are rowing all together, because if this doesn't work, you know, it's gonna close off a conversation that we've been able to open up over the last 4 years, and I think everybody loses as a result of that. But if you talk to the founders who work with us, they want to be the company that returns the fund 3 times over, not the one that pays us our 3x and kind of screws us at the outcome. Let's do one more question, and we'll call it a night for now. Of course it is. Oh man, I have no idea. I mean, we haven't done any age dynamic. I would imagine if I mean, we've got 40-year-old dads with 2 or 3 kids, and we've got, 21-year-old, first-time entrepreneur, living in a loft, in a bad part of town. So, I don't know that we have, it probably averages out to be kind of a meaningless number. I mean, I think that age isn't, has never really factored into, where we invest. I think that we, from an industry experience standpoint, I've been pleasantly surprised at the caliber of entrepreneurs we've been able to attract. Many of them are coming as experts in their field. Many of them are coming as previously, and similar to David, like had raised venture money before, didn't want to sign up for that path right out of the gate again. And so they're looking for an alternative and a different community to be a part of, to share their experience with, to learn from others, but not necessarily to have to buy the whole package. Okay. Well, I can hang around for a little bit. So if you didn't get your question out to David or I, I'll hang around for a bit if you have direct one-on-one questions. But really appreciate all of you coming out. I hope this helped clarify a little bit of what it is we're trying to do. And I hope if any of you were on the fence about applying to V3 that we've sufficiently gotten you off of it. So thanks a lot.